Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject mine. Generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me at Financial Square Finance, and if you want to join our community, finding-value.com, where I dive deeper into all this stuff, looking for potential investment opportunities and sharing them with the community. We do have that coupon code special, which is a larger discount if you'd like to sign up and try it. And we've got a larger discount on the yearly membership if you'd like to sign up for a year. So starting with Tavi, we got the world is experiencing a real-time history lesson on the significance of gold and the history of gold cycles. So let's go over the history of gold cycles real quick. Falling gold production. You're going to see that across all of them. So the first cycle from 1970 to early 80s, falling gold production, inflationary regime, central banks accumulating gold, and lack of new gold discoveries. Once that was reversed, the gold production and gold discoveries, we had a huge consolidation. This consolidation is in fact from gold being overvalued. Gold, we could have went back on a gold standard and covered the entire M2 money supply in 1980-81. So we consolidated. Stocks took off. We had high interest rates. This was an increasing interest rate environment here. We peaked, it turned, and everything consolidated for a long time. In the late 1990s, early 2000s, we had falling gold production. Gold to S&P 500 ratio at historical lows, and China driving commodity demand. Another big boom occurred when gold was very undervalued in 1999-2000. It was one of the most largest undervaluations of gold in its history. So that we had another big boom all the way to 2011. Now, what do we have today? We've got falling gold production, central banks accumulating gold, government debt at historical levels, unsustainably high fiscal deficits, gold to S&P 500 ratio at all-time lows, G7 economies entering a manufacturing revitalization era, rising deglobalization trends, the onset of an inflationary era, 60/40s looking for haven alternatives, lack of new gold discoveries, ultra-capital conservatism by major miners, a trifecta of macro imbalances. We've got a debt problem of the 40s, and inflationary issues of the 70s, and asset valuation imbalances of the 1920s and 1990s. What he means is we have very low gold prices in relationship to stocks. We had a bond market that bottomed in interest rates. Interest rates started to come on up, which means we topped in bond prices. So bond prices have been falling, and it's looking for a new home. We are in a new inflationary, increasing interest rate environment. So money is rotated out of bonds, and a lot of the money went into stocks. I think that stocks will peak out at some point, and the money is going to have to rotate into something else, which is going to be very similar to the 1970s. We're going to get a huge bull market in gold, silver, commodities, energy, and all of that stuff. It'll probably be the biggest commodity bull market of all of them. And the reason it could be is because of the asset valuation imbalance of the 20s and 90s. Everyone is over in financial assets, and that's all going to have to basically unwind itself. And then it's going to look for returns. Go wherever the returns are best, which will be commodities and precious metals. A great infographic on Canada and Mexico's supplies of heavy crudes to U.S. refineries. So here's Canada, 876,455,000 barrels. Mexico with 240,356,000 barrels of oil. We've got a whole bunch total barrels from Mexico and Canada. And I'm guessing this is on a yearly time frame. You can see all the heavy oil where it's going to refineries all throughout the United States. The United States does not produce a lot of heavy oil. In fact, our heavy oil has been declining over time. We produce a lot of light oil, natural gas liquids, and natural gas and propanes and all that stuff. And we export a lot of it because we don't know what we can do with it. Christine says, when the call on natural gas supply arrives, the biggest winner will likely be drilling rigs. Let me say that again. When the call on natural gas supply arrives, the big winner will be drilling rigs. So look at the data here. This is rigs drilling for oil and gas in the United States from 2000 to 2024. The annual average active rig count by primary target. Look at natural gas. Natural gas was the big driver of all those rigs' demand back from 2000 to 2014. Now, it did change from 2010, 11, 12, 13, 14. We did see a large rig move to oil. And ever since then, we've been trying to do more oil than nat gas. With all of the LNG terminals coming on, with all of the demand for electricity coming from natural gas, I think nat gas is going to be a big driver of rig count. So we'll see what happens. And when the price of oil and natural gas go up together, I think rigs will be a huge benefactor of the rig count will go up, put it that way. We're going back to more normal levels. This is U.S. rental vacancy rate from 1965 to 2024. You can see crisis levels occurred in the 60s and 70s. You know what that was? The big inflationary era of the 1970s. This is where it came from. Not rentals, but from the real estate market. But rentals are also still low. We were in crisis level, 2021, 22, probably 2020 here too. We've come up a little bit. I'm interested to see how interest rates impact all this. I think home demand, not rental, but home demand, I think will go up if interest rates fall. I also think that inflation will go up if interest rates fall. Coming down, Patrick Karam says, I know, so much bearish sentiment out there. Bottom has to be in, right? He says, I still think Nvidia is in a bunch of trouble and can slip up at any moment. Targets would be the 90 to 95 support range, rising wedge, breaking out of that rising wedge, and maybe we drop even further to the downside for Nvidia, is in his opinion. Housing, construction, employment, and spending. I put this up here. I look at these as some of the data. Total construction, it's still going up. It hasn't basically reversed and turned over. We did reverse in 2022 for a little while, but we're back on pace heading on higher. We also have U.S. construction, all employees. We had a big move lower in 2005, 6, 7. It's still going up, but we are seeing some weakness in construction in terms of job openings. Is that the beginning of the turn? I wouldn't say it is necessarily. It's data, but if interest rates do drop, we have to wait and see. I think all employees construction, if this rolls over, that's a real bad sign. And it very well could. This is total construction in the United States, up, 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 up. You can see the bottom was about 2011 beginning, and it's just been higher ever since. Big turn in 2006 or so of heading lower, and this was the beginning of that crisis. And coming on over, this is United States housing starts. You can see the big move higher. This hasn't been updated for this month, but the last month it came out, in the middle of the month, they released this data. You can see it's very similar to this period here. 1999, 2000, very similar. And maybe we go all the way up here for a while to build that shortage. But I think interest rates will be the driver of this. The affordability. Now, the reason I say that is we had huge demand in 2020, 2021. There it is, coming on up. It's pulled on back when interest rates shot higher. We'll see what occurs, and we'll continue to watch this data here. RevCap, it says housing and non-residential is lower. So this is job openings. Construction job openings fell to the lowest level since the depths of COVID, April 2020 in December. There it is coming down. And Is that bottoming? Tough to say. Is it going to have an impact? These are job openings. Um, I would say if job openings decline and we see U.S. all employee construction roll over, yeah, that's definitely not a good sign. This is a very bullish setup for copper in my view. The metal looks poised for a major catch up as gold prices surge. So he's got gold prices in the white surging, and then we've got copper prices still consolidating underneath the downtrend line, looking ready to break out. We've got the 1, 2, 3 hump consolidation thing going on. And I do think copper is going to make a catch up move. I think he's right. North Star says this chart, amongst many others, says the stock market plunge could happen at any point now using, it says, U.S. hearing in the gold bull era. It's probably ushering. Yeah, there you go. Dow Jones Industrial Average versus gold. You can see we've got the breakdown. So moving average, Ichimoku cloud, and support line. Dow crash, an enormous gold bull market is coming. So capital rotation evidence, everything in the red box is in bear market priced in gold. We need to get the S&P 500, the NASDAQ, and some of these other ones to be in red before we get basically a total outperformance of gold. But all of this is happening. I'm going to continue to go over this all the time when people post this stuff, and I can post it too, I guess. Why is it such a big deal? Money rotates when they get hit in the face. So there's a quote, Mike Tyson's quote, everybody has a plan until they get punched in the face. That happens with capital rotation. Everyone's happy until their account value goes down, and then they start to chase returns. They're forced to sell if it's going down. So what occurs is you'll start to see gold outperform Dow Jones, S&P, and people won't rotate money if whatever they're in is working. As soon as it stops working, then the money starts to rotate. That's your capital rotation going on. So everyone has a plan until they get punched in the face is the correct statement. Everyone's going to be in tech and S&P until their account values start going down, and then they're going to start to move it to precious metals and commodities and whatever else is working. It's just money chasing crap. Smart Real Estate Bets, he says, since many of the doomers love to point to Phoenix as a place that is primed for a crash, it's not. But they don't know crap about the market here. January 2025 single-family home prices were up 6.1% as home sales grew 5% versus January of 2024. I like this guy. Why? Because he looks at the data and then he looks and draws accurate conclusions from the data. It has nothing to do with fulfilling whatever bias someone has. The problem is the doomers get a positive feedback loop based off of views. So they post a bunch of negative crap on YouTube, and negative crap gets more views on YouTube, so they continue to post more negative crap. They post so much negative crap that they start to believe the negative crap. And then they sound like they are crazy. Harry Dent posts a lot of negative stuff. Reventure Consulting posts negative stuff nonstop. These guys have been wrong for many, many, many years. But the positive feedback loop from YouTube and the increased views, the increased revenues that they are generating from that negative sentiment keeps them negative. The Money Cruncher says if you make $150,000 in W-2 in 2025, you will pay $25,247 in federal income tax, and then you've got $11,475 in payroll tax. If you make $150,000 from long-term capital gains, qualified dividends, you will pay $13,000 in Fed tax, almost 3 times less tax. The tax code favors investors. Someone did make this point that this here was money. This money made was already from money that's been taxed somewhere else. That is somewhat true. I do think that the federal income tax is pretty jacked. The whole system is jacked because this is what they do. They debase the currency, which then your assets try to make up for that debasement of currency, but then they tax your entire quote gain. I mean, technically, your gain is not a gain unless you can purchase more with it. So if they suck out 9% out of the purchasing power out of the currency, and your account goes up 10 or 11% and you pay taxes on it, you basically didn't make any money. So that's the problem. It's difficult to have increasing purchasing power from investments and actually beat the inflation rate that they're sucking purchasing power out of the currency. It's really tough, especially after the you take the tax out. Casper says uranium prices going back 60 years. According to long-term data, the peak of the uranium spot price has been suggested to be in the range of 300 or 400 per pound. He's using this green box up here, projecting it over. It's about $300-400 a pound. That's where he thinks it might go if it were to go to the top of this kind of wedge channel going on. I think we're going to beat that. I think we're going to go higher than this amount. And some, I always like the people that say, because I think oil is going to go higher too, like $300 to $600 or even higher per barrel eventually. They're going to say, well, how are people going to afford it? How are they going to do this? I don't know, guys. That's what every time in history is done. You think when oil was like $10 a barrel, they're going to say, well, how are people going to afford oil at 100 or 150? Well, that's where it went. Did you think people said in 1970 when oil was like a couple dollars a barrel that if it went to 40 or $50, they'd say, well, how are people going to afford that? That's what happened. That's what's going to happen again. It's just cycles going back and forth. Money comes into the system faster than the commodities can produce, and you get a shortage. Prices go up because of inflation, and then people have these sayings of how can people afford that? Lawrence Leopard says paper gold markets are in deep crap. Holy cow. We've got 40,650 gold contracts already delivered in 3 days in February after a heavy 22,538 delivered in January. That is completely unprecedented. London was drained, and now it's happening in the US on the Comex. Squeeze is on. That's what's happening, guys. It's squeezing. Freight futures AM update. We had dry bulk up 6% and 9% for those. Tankers were up a little bit, 2% on Suezmax, flat for VLCC. The very large crude tankers. Doric Shipbroker says surpassing market expectations. China's economy expanded by 5.4% year on year in the fourth quarter of 2024, accelerating from 4.6% in the previous quarter. This marked the fastest annual growth rate in 18 months, driven by a series of stimulus measures introduced in September. So that is good for shipping. Good for shipping. We've got crude oil. Crude oil is a mere reflection of your purchasing power. I love crude oil, guys. I love it. So purchasing power is tracked inversely by crude oil. This is crude oil quarterly log inversed. And what we got here is the US dollar index adjusted by producer price index proxy for inflation. And as this declines, crude oil goes up because it's inversed. So that's good. I think crude oil is going to go up. Peter Lynch says your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. A lot of people have all these worries and they want to sell. They want to sell at the first thing that ever comes out. Oh my God, they're going to put tariffs on. Sell. Oh my God, they're going to have this. Sell, 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 sell. You got to kind of just avoid all the noise and just ride on through it. Silver Chartist, which is Steve, he says, I don't know where all the previous uranium bulls are now, but a current one is standing right here, which is Steve. I sold November 22 and Jan 24 peaks, and I'm once again bullish with U308 being my favorite sector for 2025. Dear silver gold speculators, meet uranium. I think You both have much in common. Standing on benefit, those who speculate on your long-term prospects. So he is a uranium, silver, gold bull. I'm bullish on everything, guys. Anything commodity related, I'm a bull, or precious metals. All of it. Investment wisdom, Charlie Munger says, if you want to succeed in investments, start early and try hard and keep doing it. All success comes that way, by and large. Here's Tavi. Tariffs are not inflationary, but you go look at the 5-year break-even rate. It just surged to its highest level in nearly 2 years. I don't know if tariffs are inflationary in terms of creating this chart, but yeah, 5-year inflation expectations continue to rise, and we've broken to new highs. This is silver price 100 years and key events. So silver price over 100 years, key events shaping its history. We had the Great Depression, World War II. We had a big consolidation. What caused this move higher? There's a lot of things that are similar to today that are happening here, is all I'll say. Big cup and handle, and then we've broken that to the upside. And we've got the same drivers in place for this big move from 1940 up that we have today. In 1932, silver prices dropped to just 28 cents per ounce. Fast forward 48 years and silver reached an all-time high of about $50 in 1980, only to enter a prolonged bear market that persisted until 2001. Since then, prices have steadily climbed with an average closing price of $28.27 in 2024. And this is all currency. It's a currency going down. Grady says, both gold and silver are respecting these parabolic trend lines perfectly. Silver morphed into a more stretched curve. Slingshot parabolic moves are in play, 4-year patterns that are stair-stepping higher. These are very, very good-looking charts. Gold, 4-year parabolic base. Silver, 4-year parabolic base. Let's go parabolic then. Let's send it. Charlie Munger says, patience and aggressive opportunism is what you need. It's an odd combination, but it's what works best. He described exactly what I am. I'm aggressively opportunistic, and I'm patient. I had to learn the patience. The game taught me to be patient, and then you have to be optimistic. You cannot be pessimistic. You can't, because you'll sell out. And you can't be impatient. If you're impatient and you're pessimistic, all you're going to do is sit in cash the entire time. If that's what you want to do, go do it. But what I've learned is you have to be, I'll say, you have to be opportunistic, or you have to be, what's that? I can't think of the word right now. Not pessimistic, but the opposite, optimistic. You have to be very optimistic and very patient. I agree with this quote here. By owning great companies, you can just forget about all the noise and the irrational market fluctuations and slowly get rich. You can get rich quick too. It all depends on what the company's doing and the money flows. That can also happen. But most of the time, the cycle takes about 10 years, 15 years. It's somewhere in there. And that what does that mean? What does a cycle mean? A cycle means where you make 10, 15, 20 times your money from bottom to top. That's about roughly what it takes, 10, 15 years. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. I did release the midweek update. That is available on the website. Check it out. We've got special coupon code if you'd like to join. And that's all I've got, guys. So we'll catch you next time. This is Finding Value.